Looking to make more money? Find your side hustle. It's easier than you think. Then, if money doesn't buy happiness, what does? Spoiler alert, don't push love away. And life insurance is more than a death benefit. It can help create wealth. All this and more today on The Wealthy Life. Welcome to The Wealthy Life. Expenses seem to be rising at a faster pace than earnings. Are you looking for another stream of income? Joining us today is Amelia Warren to share tips on finding the perfect side hustle. Amelia, welcome to the show.
Oh, thanks so much. I'm delighted to be here.
Now, you are the CEO of a company that works with ambassadors who they use that to generate income.
Absolutely. They're sharing our products through their community online.
So how do people get involved and what are the different options they need to consider?
Yeah, so there's a lot of ways that you can monetize what we all do, which is giving recommendations for products and services that we love. So there's influencer marketing, affiliate marketing, and also direct selling. And all of those are essentially a way that brands leverage people to grow awareness and to share their products.
So let's talk a little bit about each one. What's the affiliate model?
Yeah, so affiliates is basically performance marketing where you as an affiliate earn income for your promotional efforts. So if you share a link about a product that you love on your social channels, you're going to earn a percentage of whatever the result of those efforts is.
Now, how do you get that gig?
Well, there you can go directly to direct-to-consumer or e-commerce brands, and you can sign up online, and you will get compensation for sharing their products. You also might get free products or the opportunity to try products before they're launched. You can also go to an affiliate network like Amazon Affiliates, Commission Junction, or CJ Affiliates, or Share a Sale, and you can sign up for it. And when you do, those affiliate networks are going to introduce you to potential brands.
Now, do you have to have a big following on your own? Like, what would those companies look for before they're going to pay just anyone some money to promote their brand?
It depends which one. Amazon, it doesn't matter really how big your community is, but generally having about 500 followers or an audience of 500 is going to be where you want to start.
And what kind of money can you make off of that?
For affiliate marketing, you're going to make anywhere between 5 and 15% of everything that you sell.
So in tracking that, is there a separate code then or a link? So if I were to promote something, say, wow, this is a fantastic watch. I'm not wearing a watch today, but I highly recommend it. It keeps me on time for everything. Then for every time someone buys that watch from my link, I would get paid?
Absolutely, 5 to 15%. Yeah.
Now, tell me a little bit about the ambassador
Yeah,
route.
so brand ambassador is essentially affiliate marketing. There's also direct selling or social selling, which is where brands engage folks to sell their products directly. And in that case, there's a low startup fee in exchange for you getting free products, getting a back office, an e-commerce site, so that you can share those products that you love with your community, your family, and friends.
Is that still common out there today?
Yeah, I mean, the direct selling and social selling space continues to be it's a multi-billion-dollar industry that continues to grow, and there are thousands of companies and a lot of great products to represent.
Right, well, I think about back in the day from when I'm a little girl, everyone knows what Tupperware is, but that would be an example of direct marketing back in the day.
Absolutely.
But now maybe is Tupperware still direct?
Tupperware is still direct, and they're going to be leveraging both online tools and offline tools to share their products.
Okay, let's talk a little bit about how people get started then. So you mentioned they can go online, they can check out these things, but there's probably some cautionary tales.
Yeah, absolutely. So I guess overall, you just need to pick a brand and a product that you love, right? Because the reason why people are going to be influenced by you is basically because they like, know, and trust you. So you need to make sure that the brand you're aligning yourself with is one that you love and you can represent authentically. You also need to make sure that whatever brand you're connecting yourself with, that has a good reputation and they're not making misleading claims around how much you can earn or what that looks like. And that whatever you join, you need to know that, like everything in life, it's an efforts in, results out game.
Right.
So you're going to need to work it and be consistent.
Now, I know you specialize in the food products area. So people who are passionate about eating healthy and like the foods that you produce would be a good fit.
Absolutely. And I do think that, you need to look for a brand, again, that you like and love, but also having a product that is a consumable product is always going to be a good product to represent, in that you're not just going to get the initial sale, but you're going to get recurring revenue, which is what I think we're all looking for in, a side hustle or an additional stream of income.
Yeah, because if I sell 10 watches, but those watches are really good and last 50 years, that's not going to help me out.
Watches.
Yeah, and so what do you see in terms of average income that people are making off of these side hustles?
Yeah, again, it totally depends on, how much effort you put in. And so for many people, it's like a couple $100 extra a month. For some people, it becomes a full-time gig.
So where should people get started? Where's the first place they should look, or what's the first thing they should think of to find the right product or brand?
I think, one, it's finding a brand that you love and go to their website and see if they do have an affiliate or ambassador program. Amazon is also a great place to start. And then again, there's a number of direct selling and social selling businesses, and you can go to the Direct Selling Association. And also the Better Business Bureau is always a great place to look to find out the reputation of the company you're aligning yourself with.
Good advice. So best place to start, just go on the website of the company you like. Amelia, thank you so much for being with us today.
My pleasure. Thanks for having me.
And up next, money can't buy happiness, or can it? Find out after the break. For low and median income families, money does buy happiness. But after that, there's something else that matters much, much more. Resilience expert Andy Bernstein is here to show us how to find happiness beyond anything money can buy. Andy, welcome to the show.
Thanks for having me.
So Andy, let's talk about that for a minute, because people do think money can buy happiness. Why is that not the case?
Well, it can be the case. As you mentioned, for people in poverty, money does translate to happiness. It helps you buy food, clothing, shelter. So, money equals happiness for millions and millions of people. But the longest running study of human well-being, called the Harvard Grant Study, and other studies have pointed out that after a certain threshold, more money doesn't equal more happiness, that there's something else that we need to focus on more.
And what is that something else we need to focus on?
Well, this is a subject of some debate, but my take on this Grant study and other studies is that the thing most aligned with long-term happiness after that financial threshold is the ability to not, quote, push love away, unquote, in the face of challenges. The happiest people into old age have a toolkit for repairing their relationships or family estrangements and other challenges so they keep their relationships strong.
Oh, I can see that playing out in so many different situations. You think about people we know that when they get to the end of their life and all of a sudden they want to repair some damaged relationships.
Yeah, especially as we get older, because of how we're hardwired for these close connections to our tribe, as we get older, those disconnections weigh more heavily on us. And so we can spend our lives focusing on money, and we think that we're going to get to retirement, and if we've got all this money, we're going to be happy. But suddenly we realize that actually we wish we had a strong relationship with our kids, or were more present with our grandkids, or had handled a divorce differently. So the emotional component actually means more to us as we get older.
Well, and I see other situations where people are so focused on making money, it's all about the money, and they don't find happiness. As a matter of fact, they get worse off. They're worse off emotionally than when they started. They've missed the whole point of what the money is for and what really is important in life.
I think of it as different spans. Like there's your lifespan, which we're all pretty aware of. There's your health span, which we want to maximize. So you can live beyond your health span and still keep living, and it's not a lot of fun. There's your wealth span, which is where you want to have enough money so that even into old age you can cover your needs. And what I think of as your joy span, which is even with health and money, you may not be happy. And the ideal would be to extend all of those so that they're lined up.
So what can people do to feel happier? Because we all want to be happy. Well, at least I hope we all want to be happy.
Yeah. I think, so the difference that I try to share with people is we're not trying to maximize, because of this study around not pushing love away, the real key to happiness isn't trying to maximize more positive experiences. is trying to minimize the negative experiences. So the happiest people aren't the best at being happy. They're the best at not being unhappy and having tools to help you cope with real challenges and not take it out on your spouse or your kids or your siblings. That's the area that I want people to focus on.
So how can they do that? Do you have some tips and techniques or exercises people can do?
I do. So I created a process that came out of my own experiences with challenges. I've shared this with you in the past, but I grew up here in New York City, where I'm speaking to you from, and I had a happy childhood. And when I was a teenager, my father and my little sister passed away unexpectedly in separate incidents. And I share this not because I want to depress people or overshare, but because it started me on this journey to understand what's the best practice for dealing with challenges in life. And I tried a lot of different processes, traditional, alternative, self-help processes. And at the end of all of that, what struck me as being the most useful was having this ability to shift the way that you think in the face of change. So having a tool that helps you reframe or shift mindset when bad things happen, for me was the most powerful thing. And so I created this 7-step worksheet that helps flip a switch in how you think faster without stigma or therapy or touchy-feeliness. And I offer that to people as maybe one tool to consider in their toolkit to handle challenges.
You know what, Andy? I actually view it as a bit of a superpower. I've been fortunate enough to have been through that process with you a couple of times over the years at various conferences. And let me tell you, it works. And that 7-step process is actually in my head. And the more I practice it, the more I'm aware of it, the easier it becomes. And thank you. It's really powerful. Yeah. So we don't have time to walk people through the 7-step process today. Where can they go to learn more?
Well, so the process, as we say here in the U.S., the process is free to try at resilienceacademy.com. So they can go to the website. My goal is to help make it as accessible and as easy to understand and risk-free for people as possible. So Resilience Academy gives people a chance to try it for free. But really what the process does is it takes something that happens naturally for all of us whenever we challenge our thinking, whenever we have an insight that just shifts the way that we see. Let's say you get into an argument with your spouse, and then you realize you were mistaken. I'm sure that's happened to all of us. That's an insight. It's an example where this light bulb goes on over your head, and you suddenly see the world through new eyes. The same thing can happen with any challenge in life. When you struggle with it, and suddenly you see it differently. The Resilience Academy, the process that I share there, is a way of reproducing that, so that people can take something that's maybe a little bit elusive and make it available on demand.
Well, Andy, thank you very much for sharing this with us today. I hope our viewers take action and feel happier as a result.
That'd be great. Thank you.
And stay tuned. After the break, we'll learn how you can use insurance as an investment. Is it possible for you to live wealthy now, leave your kids better off than you were, and also spark a financial legacy of wealth and empowerment that lasts for generations? With us now is insurance specialist Uriah Kane to share how you can use insurance as an investment to accomplish all of the above. Welcome to the show, Uriah.
Thanks for having me back. It's nice to be here.
Well, this is quite the opening.
It is.
And it's quite a statement. So I think everyone wants to know, is this possible?
Yeah, absolutely it is. And my area of specialization is to kind of help clients and their advisors and their accountants kind of build a plan around how to build their wealth, reduce risk, and leave a larger legacy to their family through insurance. And who would have thought that setting up a life insurance policy and funding that policy beyond just the cost of insurance could create such an impactful strategy for financial planning?
I know. I think it's because most people just don't really understand how life insurance can be used. Obviously, people need it to protect their family if something happens to them. But there's a lot of situations where they can use life insurance for more than just that protection.
Yeah, no, exactly. When you think insurance, you think risk management, right?
Yes.
Do I have enough to pay down my mortgage? Can I replace my income if something happens? But the strategy of using insurance as an investment or as an asset class is the term we use in the industry, allows for some very advanced financial planning where we can project out retirement cash flow numbers for clients, and in situations where they've got more than they're going to spend, because that's always the question people have, right? Do I have enough?
Yes, and that's the one question that a financial plan will answer.
It is.
How long will your money last?
Right, and if we're able to kind of forecast those models for them using financial planning software and say, hey, look, not only are you okay, but there's going to be a lasting financial legacy left behind, then the conversation pivots towards like, what can I do to, grow my wealth, reduce tax, reduce volatility in my portfolio, and using insurance as an asset class, and specifically cash value permanent life insurance, is the strategy and the product that we're using to kind of help clients navigate that plan.
Yeah, because term insurance won't do it, because explain what term insurance is.
Right, yeah, so there's two kinds of insurance, right? Temporary or term insurance and permanent insurance. And term insurance, I always explain it, it's kind of like your car insurance. It'll cover you for a specific period of time. But for many people, when they need it most, it's so expensive, they can't really justify keeping it. There is a second option, permanent insurance. There's two different kinds of options there, universal life and participating whole life. We typically tend to use par whole life insurance as a means to overfund the policy and build that underlying investment inside the contract.
So who is this suitable for, this strategy, and then how does it work?
Yeah, good question. Two groups predominantly kind of stand out in the plans that we're building. Group number one are clients who have a very large non-registered account. I've seen it with clients who have been executives in oil and gas companies, people who've sold the family cabin or cottage with this massive cash windfall. And as that non-registered, account sits there, there's a potentially tax on growth problem and a tax on death problem as well, depending on probate and some of these other concepts that are out there.
I don't like tax problems.
No, yeah, exactly. I mean, most of the people I meet with, if we can show them ways to save tax, they're at least interested to kind of learn more about what their options are.
Yes.
Group number two are all of those, incorporated professionals, doctors, dentists, entrepreneurs, business owners who are accumulating wealth corporately. There's been decades of advice that would suggest, take your excess retained earnings inside the company and keep it there. Don't pay it out as a salary or a dividend to yourself.
Because then you pay tax.
Because you pay tax. But then the question becomes, well, where do I put it? Stock, bonds, mutual fund portfolios, real estate. There's a plethora of different options that they can look at. But as they accumulate their wealth inside that company, there's a tax on death issue as well. And again, this strategy of using insurance as a means to address estate tax issues is always important. But to be able to use it to kind of grow wealth and access wealth while they're alive are just a couple of the different ways that we can kind of structure that strategy to be able to kind of help them. So we accomplish a number of different financial planning objectives with one strategy.
Can you give us a Coles Notes version of how it might work?
Yeah, so people need to qualify medically. So that's one of the questions we always get, and that's the caveat. But we set up a life insurance contract based on their ages and their health histories. There's a whole process to kind of get that structure in place.
So assuming you're eligible,
yes.
Then what happens next?
What happens next is we then fund it either as monthly or annual premium payments, and we like to set these up over typically 10 years so that they're not committed to a payment or an obligation for the rest of their lives, but for a short period of time. We overfund it.
You've assessed that they've got enough money to fund their insurance and then some, so you shelter a bunch for 10 years. And then what happens? What
happens at that point is the policy is able to self-sustain itself. It continues to build and compound. There's never a tax slip, a T3 or a T5 that's being issued by the insurance carrier. And all of that growth happens tax exempt inside of that structure. We can do it personally, and we can also do it inside of their private company as well.
And then it pays out tax-free?
It pays out tax-free. There's a portion of it that might be taxable, but for the purposes of this conversation, especially in corporate scenarios, there's a large CDA credit that's called a capital dividend account, which allows the business owner, deceased at this point, their estate to be able to kind of draw out that wealth tax-free from their company, which is such an important part about why we're suggesting that planning for them.
So people can have it all.
You can grow your wealth. You can reduce tax. You can reduce volatility in your portfolio and still leave a larger legacy to family as a result of that planning.
Uriah, thank you so much for sharing your wisdom with us today.
Thanks for having me.
And up next, how much money do you need to retire? We'll find out after the break. Welcome back. Thanks for your emails and social media messages. We love hearing from our viewers. Today's question is from Audrey. Dear Sybil, I'm in my early 40s and would like to retire at age 60 or 65. How much do I need to have saved by then? Thanks, Audrey. Audrey, I'm thrilled to hear that you're starting to think about retirement savings now. Will you still have time on your side? Now, unfortunately, there's not a one-size-fits-all answer. How much you need really depends on you personally. One of the things you can do to start is write down a list of all of the expenses you think you will have in retirement. What's it going to cost to put a roof over your head, food on the table, all the basic necessities to live, your utility bills, but also what about the fun stuff you want to do? You may want to go on a trip around the world, or buy a new vehicle, or buy a boat, or spoil your grandkids rotten. All those things cost money. So we have a worksheet at thewealthylife.com that can help you assess what your future income needs may be. Once you've decided how much you're going to need to spend, the next thing you're going to have a look at, what future income sources will you receive? Maybe you have an employer that has a pension plan. Maybe you're eligible for Canada Pension and Old Age Security. When you add up all those types of pension incomes, that will reduce the amount that you personally have to save for yourself. Once you've calculated the differences between the two, there might be a gap. That's the gap you're trying to fill. I'm just going to give you a hypothetical example of how much you would need to save to build up a nice surplus 20 years from today. Let's say you wanted $1 million in savings to help fund your retirement in 20 years. To do that, assuming about a 5% average rate of return on your money, you would need to start saving $20,000 a year, starting today. So hopefully that'll provide a little bit of guidance. You're going to want to meet with a financial planner to calculate a specific plan and number that's right for you. And that wraps up this edition of The Wealthy Life, helping you make smart financial decisions. Join the Wealthy Life Club and you'll get access to everything you need to live your version of a wealthy life.